And welcome once again to the Mark Osler Retirement Experience. My name is Randy Cook. I'm here each week with Mark as we sit down and talk through some of the financial headlines, some of the things that you're seeing out there, and probably some of the things that might be worrying you out there. And certainly we've got a lot to talk about today as markets are kind of topsy-turvy at present, and we're in correction territory. And Mark and I have used the term financial amnesia in the past, and we forget that this kind of stuff can happen. So we'll deal with that as we go through today. Mark, how are you doing today?
I'm fantastic, Randy. It's a great day. I'm looking forward to having our good financial talk here, and you're going to inform me just like I'm going to inform you, and we're going to inform the people together.
There you go. And so you've been doing some seminars at Ray's Restaurant, and you've been doing some things like that. And I know that there's a lot of questions out there about where the economy is going right now. We're starting to see some of the effects of the new policy, and President Trump told us that we would be in for a period of pain, and I guess we're experiencing that right now. How is that playing with your clients right now? Are they real worried, or are they going to be patient with all of this?
So we have these conversations like, hey, I'm going to retire in 2 years. Is this what I really want to experience as financial turmoil? Mm-hmm. So I talked to a guy the other day that happened to watch my commercial. He watched it on either CBS or ABC. I'm not sure. I alternate each weekend. And when we were talking about stuff, one of the things that came up for him was it looks like his income's going to be just fine, but his nest egg, he's worried about that. I said, well, look, are you still in your accumulation phase of life? And in order for us to diagnose this, I have to ask you certain questions, because accumulation, you're just trying to make the most money you possibly can. It doesn't necessarily mean you have to have all your money in the market. You could have different sets of monies, and you could have a correlation that's a little bit more balanced. But what I can say is this, that if you have like 2 years left before you retire, there are provisions we can use like annuities in those cases.
So one of the questions that is asked on every financial network, I find it actually kind of entertaining when we go into times like this, is they ask everybody, is this the start of something bigger, or is this just a blip on the radar screen that we're going to come out of? Because I look at this and I say, is this all policy related, that we're seeing the results of the tariffs and all that's going on there? Or did that trigger what we know to be happening every 300 days anyway, and that's a correction in the market? Is this what started it, and we're going to come out of it? It's hard to answer questions like that, but what's your take on that?
My take is always news does affect the market. Mm-hmm. So if you got your president saying that we're studying tariffs, we're going to impose the tariffs. Wait, let me pull back for a second. We have a study by April 2nd. Okay, which one is it? It's going to affect the markets, and the big boys don't want to feel that turmoil, so they're going to affect the market the way they want to and get liquid in positions the way they want to. And we can't do anything about it other than participate. So what do we do about that? We make provisions so that we don't feel that rocky ride if we don't want to go through that, if we're not 35 years old, right?
There you go. Do you want to be on the roller coaster or the lazy river? That's what I like to say. I kind of like the lazy river myself. Well, the headlines out there are kind of confusing when you take a look at this. I was looking at my news feed on my computer, and I found two stories back to back, okay? I clicked on one, read that, then I clicked on this one. So the first one said, odds are that the market has finally bottomed out. I said, okay, that's good news. And I hit the next one. Vanguard says there could be a dramatic market slowdown ahead. So I'm like, yeah. So you and I talk about this all the time. The financial headlines, they just give you whiplash.
They do. And one of the things we talked about a couple weeks ago, and it was over a month ago, that Warren Buffett had pulled a bunch of money out and put into a cash position. Right. And that was before we start to see that decline in the market that we saw. Mm-hmm. So obviously these guys know a little bit more about this. They make the market, but we participate. And sometimes when we participate on the things we hear or see, it can affect everything. And we know that media can drive the storms.
Yeah.
They can drive those storms. They can drive the overall story. Do we have to have all our money in the market when we're coming up on retirement?
We really do not. And we shouldn't, probably.
No, we need to be diversified. Yeah. And that's one of the things we talk about often. What is a good diversification tool for you? Maybe it's real estate. Maybe it's fixed index annuities. Maybe there's a way to be uncorrelated to the market where we look at structured notes, alternative investments like that. So there are different ways we can do this. And you know what? We can still manage money too. And I love doing that too as well.
Well, let's go into that just a little bit here. The stock market has been pretty volatile, and we feel like we should be doing something. That's kind of why we have this show. Give Mark a call, talk to him, and find out what you can do if you're right on the edge of retirement, or 3 years before retirement, or 5 years before retirement. It's going to depend on where your time horizon there. But Carrie Hannon is with Yahoo Finance, and she has a couple of steps that we could maybe follow as we go through times like this.
So the first thing, number one, I tell people, and all the advisors I've spoken to today, say, wait, sit on your hands a little bit. Wait before you make any big emotional moves, okay? Number two, it's important to stay in equities, no matter how close you are to retirement. This is where your growth is going to continue to come from. That said, the older you are and the closer you are to retirement, you need to shift a bit into, some cash equivalents or some great fixed income opportunities. We're just at the beginning of what I would anticipate to be a few years of volatility. And so periodically you should be rebalancing anyway, but this might be a good time to have that conversation.
All right, so there's your list. Wait, don't freak out. Don't give up on the stock market. Lock down some fixed income and rebalance your portfolio. Sounds like a pretty good list.
It sounds like a good list. The only question I have, Randy, is this only coming from a fiduciary standard of care?
Mm-hmm.
Is this information only coming from, are we to believe that we should all be in stocks, bonds, mutual funds, bond funds in general? Because that's what it sounds like I'm hearing.
Mm-hmm.
One of the first points she brings up is let's not make any emotional decisions right away. Well, first and foremost, I tell my clients not to make any emotional decisions.
Mm-hmm.
We rationalize what we do. So we bring to the forefront what we want to talk about, which is what you need. So we address your needs first. So when she brings up all of these points, I think she's got some good points, but that's only for the market money. We need to find out what we need to do outside of the market as well, so we can, of course, rebalance in the market, but also have other tools necessary, maybe some income planning tools, because they're really important in retirement.
It's a great point that you bring up, because we think of the word diversified and someone walks in your door and says, well, I'm diversified, Mark. I have 17 mutual funds. That's not diversified. Yes, that's diversified within the market, perhaps, but the idea of having money in the market and out of the market, I think that's a place that they have a question mark over their head, because our whole lives we've just been pounding money into our 401ks, which is basically mutual funds, index funds, bond funds. It's all market money, isn't it?
It is. And that one of the things that we like to address right away when a person's coming, I said, look, if you want to give me your statements ahead of time, fantastic. I don't care if you block at your account number and everything. I'm a professional. I've been doing this a long time. I love what I do. What I can tell you is that the first thing we do is we run a report. So whether you want that report on the first or the second appointment, it depends how quickly you want to move and see what we can do about your situation. What I can tell you and what's most important to me is running that report, we figure out, what's your level of risk and does it match what you're doing?
Mm-hmm.
Then we look at what stocks or equities or bonds are moving in the same direction. We look at the credit quality of the bonds, and then we look at how can we do something different based on what we're looking at here, because more than likely you have all market money. If you have all 401ks and you've just got brokerage accounts, you're all in the market. And so these are things we like to do. We like to address the report, talk about it, and see if it matches your risk tolerance.
So we look at markets and we look at economies like this and we see the market go and then do all these things, and you wonder, what should I be doing? Because your whole life, in your 30s, your 40s, your 50s, you're just pounding money into this 401k and whatever you're saving money in. And then you start to get to a point where you're going to probably use that money. So you have a different mindset. This is where Mark is. This is where he lives. He helps people preserve their savings. And that's what this show is all about. Let's give you a real good look at what your retirement looks like. What's your paycheck going to be? And I don't mean just Social Security. What does that 401k do for you? How does it become a paycheck in retirement? How do we preserve that money and make sure that we've got a plan to make this money last for 25 and 30 years? That's kind of a good feeling to have a plan like that. Let's sit down and do it. Here's our number. Here's our website. Moretoretire.com is Mark's website. Moretoretire.com. Go all the way down to the bottom of the page, and there's a form fill there. You can fill in a little information, and Mark's team will reach out to you, and we'll talk about What do you want to talk about? What has got you concerned? What's got you bugged? And let's sit down and have a conversation about it. You can also call us at 984-300-1984. 984-300-1984. All right, so we talk about people that are getting ready to retire. And one of the things that happens when you get into your 60s is you start to see some of your friends retire. And then you start to say, well, what date would I like to retire? And you say, okay, well, Medicare happens at 65. Maybe that's when I'll retire. Or 67 is my full retirement age for Social Security. Maybe that's when I'll retire. But here's a sad stat. About almost 50% of people who pick a retirement date don't get there. And it's not because something horrible happens. 65% of them are pushed out of their workplace because they get, downsized or something like that happens. Sometimes it's a health event. So if that happens, what do you do, Mark? I mean, that is one of those crisis situations. I'm 63. I thought I was going to go to 67. They just downsized me. I really don't want to retire just yet. What do I do?
This happens all the time at RTP. Just talking about Research Triangle Park, it's the largest research park in the world. Did you know that, Randy?
No.
Yeah, it's huge. And so what we have in our areas, we see this all the time. We talk about IBM. That's a company that likes to push people out pretty early. Mm-hmm. I've had a lot of clients that come to me. They've left IBM because they say, hey, you're 55. We want you out of there. Like, wow. Hey, I want to do something still. Oh, we'll give you an early pension, whatever. They don't want to sit on their rear end. Mm-hmm. They want to go to work. Mm-hmm. And so there are places like Lenovo and other folks that will hire people at that age, and they can keep working, mm-hmm. And that's great. But it's not the case for everyone. As a matter of fact, and this is kind of a little sad for me, but, my father-in-law, he retired early simply because he worked a very hard life, mm-hmm. and he ended up passing away at 61, about 8.5 months before he was going to draw Social Security. Oh, my gosh. And for me, that's devastating. Yeah. This guy worked his whole life, okay? He worked really hard. So when I see all of these scenarios and we talk about how they play out and what's going to happen and what's going to occur. I had a guy at the airport just yesterday telling me, he was like, look, I'm about to turn 62. I think I'm just going to turn on Social Security. What do you think? I said, well, that's a loaded question. But seriously, Randy,
it's going to take a while. Yeah. How much time do you have? How late is our plane?
I mean, seriously. But 62 is the most common age to do it, right?
Yeah.
And then 65, and then 67, and then 70. I would say if you're going to work to 65, it's probably the least complicated way to do it because mm-hmm. you could turn on Medicare, like you said, at that same time, mm-hmm. get your supplemental policy. But if you don't mind, doing things different, again, we can also work with folks once they hit 67, they know they can keep working, and that's your age full at this point in time. And then at the same time, you can still make as much money as you want.
Yeah. There's two things I think about there, and that is if you see this starting to happen to your friends at work, they get into their mid-60s and all of a sudden they're gone. They're walking out the door with a box. You can start to say, okay, I need to be prepared for that. So this is a really good reason to sit down with someone like you right now while you're in your working years. But then if it happens, don't panic. Come on in, and now let's do the math on your retirement. I realize that your options are probably not as much as they were, 6 months or a year ago. But the most important thing here is let's do the math on your retirement.
Yes, preservation tools. We mm-hmm. talk about them all the time. When we're talking about income and income planning, that's strategic because a lot of folks don't have enough income planning in retirement. Mm-hmm. And I find that sad because when you're just looking at a pile of money, and that pile of money is what's going to make that income for you and make your retirement happen, well, let's question where that pile of money is at, what it's doing for you. Is it keeping up with inflation? Could it have dips in your retirement years? Are those real concerns for you? Because we don't have to have all our money in the market. We don't have to have all our money in the bank. But let's find something diversified. And if you look at those lifetime income riders they have with annuities, they're a fantastic tool. But we need to make this planning because if you're only planning on Social Security and maybe the pension you get from work, we need to do some other things.
Yeah, most of the time people find they need a little bit more than Social Security or sometimes a lot more than Social Security. Give Mark a call. You don't have to be in a crisis situation in order to call Mark. You can give him a call, and if you're a couple of years before retirement, this is a really good time to say, okay, I've seen this happen to my friends. If it happens to me, what's the plan? If it doesn't happen to me, what's the plan? If I decide to work later, what's the plan? And the whole key here is let's have a plan. Here's our number. Here's our website. It is moretoretire.com. That's moretoretire.com. And you go to the bottom of the page there, you'll see a form fill, and you put a little information in there, and our team will reach out to you and we'll say, hey, what is it that has you concerned? Let's talk through your concerns and come into the office and let's actually crunch some numbers on your retirement. You can also call us at 984-300-1984, 984-300-1984. So one of the things that we bring to the retirement table usually is that 401k. And you might be shocked to find out that's not free, folks. You've been putting money in there, but somebody's actually charging you to use that thing. They are called fees that are associated with your 401k. And there was a study done recently that says if you take a look at a full retirement, the average American worker loses $93,000 in fees just out of their 401ks. Now, Jack Bogle was a guy who headed up Vanguard, and his whole mission in life really was to help retirees and lower fees. This is what Jack had to say.
Do you really want to invest in a system where you put up 100% of the capital, you the mutual fund shareholder, you take 100% of the risk, and you get 30% of the return?
That doesn't sound like a good deal to me.
No.
And that's before taxes. So I know that this is a part of the analysis. You go in there and say, okay, you don't have a financial advisor right now, so you're not paying advisory fees, but you are paying these kind of fees. Is that an eye-opening moment for people, and is there anything you can do about it?
Yes, and yes.
More yes, okay.
No, truly, what's most important to me is identifying what your situation is and understanding that you understand what you're trying to accomplish out of that situation. So are you 5, 10 years away from retirement? Is income important? Are preservation tools important? Are you just trying to make the most money you possibly can? It just depends what phase of life you're in. Most of my clients have passed most of the accumulation phase of their life, and now they're starting to get that preservation/distribution phase, and that's still okay to have money in the market at the same time, but just having some diversification. The fees can be a killer, but if you know what the fees are ahead of time. So with us, on our wealth division, we have fees that we charge. It's on the fiduciary side of the business. It's a standard of care. And what we do is we charge a fee. We're not commission-based, but underlying besides those fees alone, of course, there's internal fees too. But our internal fees are lower, and that's where we can balance things out. But when you talk about the fees that you don't see and we run the reports for you, we can identify some of those fees for you. And that's really important because you get an underlying idea of what the expense ratio is. That's important because that's your internal fees. And we want to talk about that. And then we want to talk about taxes.
Yeah.
Taxes are important because that's going to determine what your bottom line is in retirement. And then also if you're keeping up with the rate of inflation.
There's a lot of things that are pulling at our money. Yeah, I mean, in day-to-day life, it's your gas bill, it's your grocery bill, it's your cable bill, it's all that stuff. That's grabbing at your money. In retirement, there's things that are grabbing at your money, and we all think it's just that stock market. That's what's going to kill us. But that's not necessarily the case. I mean, markets, taxes, healthcare, long-term care, fees, they're all there. And some of that's a little different than what we have, in our working lives have been used to. So we've got to have a plan for a whole new kind of attack, really, against our money, don't we?
One of the biggest fee-based things out there that is absolutely crushing people's money?
What's that?
Variable annuities.
Oh, okay.
If you got a variable annuity, it would be great for us to look at it and figure out how much you're paying in fees because I do an example at my presentations that I do, and we talk about how, let's say you had an 8% return, but you had 3 to 4% in fees. Can you really afford 37.5% to 50% of your money being taken away on the return?
Wow.
That's devastating.
Yeah.
So that has a huge impact on what your future returns are. And yeah, keeping up with inflation is important because we don't know what's the normal rate of inflation. We don't have one, do we?
Yeah. We've been at 9.3. We've been at 3. We've been at almost 1. I mean, it's gone all over the place. It's true. I've learned so much from you, Mark, because I went. So I'm one of those guys. I'm such a cliche. Okay, so the guy who I church with, he did my insurance, all these years, and now his daughter has taken over the business, and so now I went to see her, and I said, so show me what you would do for a retirement plan, and the first thing she showed me was a variable annuity. The first thing she showed me, and I said, how much are the fees? And we went page. On the last page, it was 4% fees. I was like, nah, that's not for me.
Yeah.
There's
not good.
There are so many different kinds of annuities. I mean, I know that people, they cringe sometimes when they see the word, but that's because there are annuities out there that are very high in fees. There are others that are not. There are others that are built for income that we talk about here on the show. And you got to kind of see through all that, don't you?
You do. And one of the pullbacks or drawbacks that people give are the surrender charge terms on just fixed or fixed index annuities or multi-year guarantee annuities. But my question is this: are you really going to use more than 10% a year out of that product that you're using? Or is it a planning tool necessary for you to grow your money and pull withdrawals from in the future? Well, I don't want anybody that wants to constantly pull 10% out of their money every single year, because that tells me it's not going to last.
Right. This is the kind of conversation that you need to have with Mark. With your retirement, you've been putting money in all these years. There's going to come a point where you're going to take money out, and it just completely changes the dynamic. You got to have a strategy for it, a plan, and we would love to be able to sit down with you and talk through that. We do that at no charge. It's a look at your retirement, and if you give us a call or use our website, we can have that meeting, and it's at no charge. Again, moretoretire.com is our website, moretoretire.com, and go to the bottom of the page there, fill out a little information so we can get in touch with you, and then we'll start the conversation and see if we're a good match, and maybe come into the office and we do a little math on your retirement. You can also skip all that and just call us. It's 984-300-1984. 984-300-1984. Mark, you mentioned to me, we talk about you doing live events and things like that. You've got a book signing coming up not too long from now. Tell me a little bit about what's going on there.
Absolutely. It's a really good friend of mine. His name is Dennis Lindsay. And Dennis Lindsay wrote a book called The Lens of the Father. And it's a great read. And he's going to be at my office on Saturday, May 31st from 10 to 12. So it'll be floating. You pop in, you come meet him, get a signature on your book, and we'll probably have some books that we could sell right here. But you can find his book, The Lens of the Father, on Amazon as well by Dennis Lindsay. Dennis is a great guy, but this is going to be a great time. So if you have been listening to me on radio and you want to pop in and meet me in person, get to know me a little bit, come on by Saturday, May 31st. From 10 to 12. My address here is 919 Kildare Farm Road, Suite 1-B. So May 31st, 10 to 12, 919 Kildare Farm Road, Suite 1-B. And if you can't remember 919 Kildare Farm Road, then we have some other issues.
Well, it's all on the website as well, and you can check that out at moretoretire.com.
Saw a t-shirt recently that said too much of anything is bad, unless we're talking about bacon. Now, we can debate that all day long, right? But the point is, portion control is a good thing. That can also be said about your retirement accounts. Too much risk, and you could get burned by a down market. Too conservative, and maybe you can't take that Alaskan cruise. Mark Osler understands portion control. He can build a retirement plan with a level of preservation and risk designed specifically for you. And if you don't want any risk at all, he can do that too. Call Mark Osler today for a complimentary meeting to discuss it. 984-300-1984. That's 984-300-1984. Or at moretoretire.com.
Welcome back to the Mark Osler Retirement Experience. Mark is here. My name is Randy Cook, and each week Mark and I sit down here and we talk a little bit about what's going on with markets. But what we also do is talk about how it affects you and what you do. What are your steps? And are you in the position now where you're getting close to retirement, and how much help do you have? Because there's so many different things that we have to do and learn when it comes to working our finances in our retirement years. So we look at markets like right now, and it gets you a little jumpy because the markets are all over the place. Ken Polcari is a guy who's on Fox Business all the time, and he says, you know what? I understand markets do what markets do, but we also have to understand that there's opportunities in up markets, but there's also opportunities in down markets.
This pullback is actually very healthy. It's long overdue. It feels certainly uncomfortable, but in times like this is when, as a long-term investor, you really need to kind of really take out your shopping list. This is very active individual stock management, right? You want to pick up names that are on sale, really good names, top of the line, the largest mega cap names in the industries that you want that are really on sale, because this too shall pass. But I do think there's going to be a little bit more churn lower.
I think we all understand the concept of a sale. We buy when things go on sale. And right now, when you see markets go down, it is kind of like a sale. So there might, if you're interested in Apple's and Microsoft and Nvidia, maybe now's the time to look at that.
Could be. I'll be honest. I mean, looking at the tech industry as a whole, that's the one that got hammered the most. And that's not surprising. Look at the times we're in right now. We don't understand necessarily what is to occur in the future. We can't figure out why inflation has not leveled off yet, right? So we have all these factors kind of facing us. Should we buy some of these stocks? Absolutely. Yeah. I think it'd be a great time, great diversification tool to buy things while they're on sale. That shouldn't be your primary course of action with regards to planning for retirement, though. This is a totally different ballgame, and this is what we focus on. Sure, as a financial advisor, we talk about how you can really have money in the market, buy low, sell high, and that's great. But at the same time, are we also using our preservation tools for retirement as well?
Yeah.
Because we want to jump into that. So, yeah, a sale's great, Randy, but what are we doing about that with regards to how it impacts the rest of our portfolio?
Another thing he said in there that I wanted to key on, he said, those who have a long-term horizon. Now, as a person in their 60s, they may say, well, I'm not a young investor anymore. I don't have a long-term horizon. But we talk about retirements that could last 15, 20, 25, 30 years. That is a long-term horizon. So how do you balance the fact that you're not an investor who's always putting money in? You are still a long-term investor because you may have a long retirement, but you're also taking money out. So this is a hard balancing act, isn't it?
It is, and a lot of younger folks, if they want market money with me, it's great. We love doing it. It's one of our planning tools, but we like to diversify and do some things a little bit differently. But there's also other things that young folks can do. They can do my favorite thing, the Roth IRA on steroids. It's life insurance. I mean, you're talking about something where, what if you make too much money to contribute to a Roth IRA? We talked about this before. You could do a backdoor Roth IRA where you can contribute to an IRA and convert it to a Roth IRA. Sure. But what else can you do where you can max out and absolutely do way more than a Roth IRA? You can do life insurance. And folks say, what do you mean? Well, there's life insurance out there where you could do either a whole life policy or a fixed index universal life insurance policy. These particular things are available for folks. They just have to stay under the modified endowment contract limit, and that's just something that's in the Internal Revenue Code. And if we do certain things the correct way by the IRS's guidelines, then you could have an income tax-free retirement right from that. And I call it a Roth IRA on steroids because you could have potentially an income tax-free retirement income, and then you could also have what? A death benefit.
It's interesting. I'm a golfer. I talk about that on the radio here regularly. So I go out with guys and they know I work with you and they look at me and they go, Randy, where do I put my money? Where do I put my money? And I go, don't talk to me, talk to Mark. Because I could give you 2 or 3 things that Mark said, but Mark can give you 20 things that he sits down and talks to people. And I think that is one of the things that people want to know. Where do I put my money? And then you have to ask those questions. Okay, who are you? Then I can kind of figure out where you want to put your money. And that's the meeting, isn't it?
It is. I mean, it's a whole process guide. If you go on the website, moretoretire.com, basically We rebranded to the Mark Osler Retirement Experience. It's an acronym for MORE, and that's where we get more2retire.com. And it's not more with the number 2. I'm not that corny. It's more to retire.com.
Got it.
And you go there, you just read of our process guide. Now, if you want to see the stuff we do in the media, we got our podcast on there. We've got some of my commercials on there. Go take a look. Look us up. We're on Better Business Bureau as well. I can tell you, we start with the process guide. We have to identify who you are, what you do, what you want to accomplish, what's your time horizon, when you plan to retire, if you continue to work, if you just want to derive a certain amount of income, and how you want to go about it. We involve attorneys for estate planning. That same law firm can do tax advantage strategies. They have a CPA. We do all of the above. And then when people want tax advantage strategies with regards to real estate, we involve those attorneys again as well. And I get involved just making sure that we collaborate and do this for my clients. So there's a lot of incredible opportunities of working with someone like myself.
Yeah, it's good to work with someone like Mark who has those connections and is the longtime almost partners, we could call them. And because if you went to your estate planning attorney on one side of town and your CPA on another side of town, and then you went to your financial advisor, trying to get all those people to talk to each other, not easy, is it?
It's not. I mean, and these folks are half a mile from my office, so it's a piece of cake. Truly, I love where I'm at. I am on, this is the best address. So obviously our area code's 919, and my address is 919 Kildare Farm Road. I mean, does it get any better than that? And Kildare Farm Road is famous in Cary. We're right near the corner of Kildare Farm and Maynard Road. I invite you to set an appointment and come to my office. You can set an appointment online as well, but I want to meet you. I want to talk to you. If you've been listening to my radio show, come on in. I have complimentary appointments. I'm not going to charge you to come in. What I want to do is identify, can I help? And that's what's important to me.
And here's how you start that process. You can use our website, again, more2retire.com. Go down to the bottom of the page where the form fill is there, and then we'll reach out to you. Or you can just reach out to us right now. 984-300-1984. 984-300-1984. Well, here we go again. I feel like I do this story probably 3 or 4 times a year, but I think it's worth doing because it continually changes. How much do we need to retire? What should I shoot for? What should be my number? There was a commercial years ago where people were holding numbers underneath their arms. What's my number? Well, the people, I think, are being influenced by the media on this, because as the number goes up in the media, then you ask people what they need to retire, and that number goes up too. So I think we're starting to feel that. This one comes from Schwab. It used to be 1.8 million. Now the number is 1.9 million. That's what you're supposed to be able to save to retire. Now, let me ask this. How many people who walk through your doors have $1.9 million?
Less than 50% of the folks.
Okay. All right.
Hopefully that'll make you guys feel better out there. I mean, I have outlier clients that are worth quite a bit of money, and then I have folks that are averaging 3, 5, 7 million. Sure, great. But still, that's less than 50% of the folks that come to my office. The folks that come to my office generally, you have a net worth somewhere between 500 to 1.5 million, and that's pretty common. That's very common. So, do you have to have $1.9 million to retire? No, you don't. I mean, we can plan around this. The key is, can we find out your expenses? Can we find out what you want to do in life, where you want to explore, where you want to travel? Can we figure out how we can make that income work for you? So there's a lot of things we can do to figure this out. But if you give me time, Randy, time is key.
Yeah.
5, 10 years, 15 years, even better. Fantastic. But start working with me earlier. Now, if you got into a situation, and I've heard folks tell me about in the past where they thought they had a year left, but now it looks like maybe 4 or 5 more years to work, that's okay. Let's figure it out together. I'm sure I can help you and tell you it's going to be all right.
Here's a couple of stats for you here. If you see these numbers, you need $1.8, $1.9 million to retire. You hear Susie Orman say $2 million is chump change. It just gets frustrating. Only 3% of retirees in this country have saved over $1 million. Again, only 3%. So that number is not your number. And here's a key thing that I think is very, very important here. Many couples, if you've worked over your life, are going to bring in between $30,000 and $60,000 a year in Social Security, and they don't figure that in to that number. And that can be well over 50% of the income that you have in your retirement years, and they don't take that into consideration.
They don't. And, you know, one of the things that's really important to me is identifying, in terms of your income, what you're going to be facing in the future. And one of the things that I am concerned with is when people have too much money leverage in equities and they don't have a plan in place. Because it just tells me, well, what's the plan? Oh, I'm just making money. I'm accumulation. That's not going to be the answer. And sure, we can figure Social Security into the factor. Having Social Security in there, that's important. But Randy, if we rely on this, we know that if the government doesn't do anything different, Social Security, the fund itself, the trust fund itself, will be exhausted somewhere around 2033. That could affect people's Social Securities by at least 20% and maybe more. And that is another thing that we play in. But again, we also have a product out there. It's one of the only products out there that I know of, fixed index annuity, that has some provisions. It's called a plan gap benefit, and it goes by this plan gap index, and it has to do with protection for Social Security. It does a lot of other things like living needs benefits and stuff like that too. So we can use a lot of different planning mechanisms and tools to answer these questions for you. We do everything. You know, when you're talking about retirement planning, we want to cover everything we can cover possible for you, so you have less questions in retirement. When you come to me on annual reviews, you have a smile, not a frown.
You know, I've been talking about buying a car for I don't know how long, and I'm now with all this tariff business. I don't know if I should buy a car, but I was thinking about buying a full, hybrid car or something like that. And, I see my neighbor's got one. And so when she pulls out of her driveway, it's all quiet because it's running on electric, right? And then you go down the road and then the engine kicks in. And now so it goes from one place to another place. And I think that's kind of a metaphor for what you need in your retirement plan, because if the market goes down, you kind of need it to kick into a different gear. You need to go to a different place. And so that you are kind of nimble a little bit, on your feet. And I don't know that a lot of us have that kind of a feeling when we're just pounding money into a 401k. This is a whole different dynamic in retirement.
Whole different dynamic. I would say that what you're referring to is a transition, right? So we could look at a transition one of two ways. We can look at it as, hey, we've made all of the money we want. We could still have some money in equities and stuff, and that's great. But let's diversify and get them into some safer places, make some income planning provisions and things like that, so that we don't have those worries or concerns that we might have normally. But it also could be looked at as, how do we just diversify in general? So diversification tool is important because you could be diversified in a portfolio, like you said, stocks, bonds, mutual funds, but do you have anything like alternative investments? And that's where we talked about structured notes too, because you could have a structured note where, as long as the bank doesn't fail, you might not lose money. That's a distinct possibility depending on the issue of the note in that particular month.
Well, we would love to have the opportunity to talk to you about all these different options and how your retirement is going to set up. And it might be as simple as, Mark, just tell me how I'm going to get paid, because that's all I really care about is every 2 weeks I got a paycheck. Can we just kind of continue that on in my retirement? Get me my Social Security, get me my paycheck, let me do what I want to do, and it's as simple as that. You take care of all the details. Or you might be somebody who really wants to get your fingers in there. That's fine too. Everybody's going to be different. Your retirement plan needs to be unique to you, and we would love to be able to build that. We call it our More to Retire process. Give Mark a call. Give him a look on his website. MoreToRetire.com is our website. Down at the bottom of the page, there's a form fill there. You put a little information in there, and we'll reach out to you, or you can reach out to us right now, 984-300-1984. 984-300-1984. Well, we talked earlier in the show a little bit about Social Security, and most people take their Social Security right away at 62. That's the most common age. Other people wait until 65 and Medicare age. Then there's full retirement age, which according to your birthday is either 66 or 67. And then there's 70. But only about 2% of people wait until 70. Well, this is a story of a guy who did. And his name is Tim. And this story comes from Go Banking Rates. And he said he took his Social Security, he waited until 70, and now he regrets it. He looks back and he says, you know what? My wife died at 68. we could have used that extra money to do some nice trips before she got sick. So hindsight is 20/20. I get that. But at the same time, that decision of when to take Social Security is a big one. And taking it early has its advantages, has its disadvantages. How do you work the math, and how do you work on what would be best for you as you look at that person on the other side of the table?
It's funny because you can find the break-even point. It's not hard. We just look at, give me your Social Security statement. Let's look at it and see. You could see the ages and what it'll pay you, and we could figure out the different break-even points. What can you live with and what can you live without? The most common age to turn it on is age 62. The question is, can you retire at 62? And I had a client come to me wanting to retire at 59 and a half years old, right? Because obviously 59 and a half, you can withdraw from your IRAs, not have to do that special thing called 72T and not worry about a 10% penalty from the government, right? So we're looking at it. And I said, in order for you to do this, there is going to have to be some type of risk, even if it is an alternative investment, okay? Even if it's a little less risk, there's going to be some risk. I said, then we can probably make it work 59 and a half, 60 years old. The person wasn't willing to do it. And I said, well, if you're not willing to do it, you're going to have to retire at 62 or 63 years old. Mm-hmm. And you know what? She was fine with that. We moved on, and we worked with that. I can tell you that the break-even point is very easy to calculate. We can talk about where you break even, what your plans are. If you flat out tell me, I'm waiting to 67 or 70, I'm not going to fight with you. Mm-hmm. Let's build it into the plan. We'll talk about it, and we'll crunch the numbers. It's going to be all rational thinking, okay?
Is there that much difference between, so my full retirement age is 67 because I was born in 1960. So is there that much difference between taking it at 67 and taking it at 70? Because that 8% run up that happens in those last couple of years seems like it's a pretty good thing to wait for.
It takes a little less time when you turn it on 70 from 67, but 67 to 62 is a pretty big difference.
Okay.
So when I look at that, it can take over 10 years just depending on the person's layout. Mm-hmm. So obviously when we want to calculate this, we want to figure out, again, Randy, you think, oh, well, my parents, they both lived to 98, 99 years old. Mm-hmm. Okay, other than the dangers of life, maybe you'll have longevity. And if you really want to do that, let's build it.
So I also think that we've talked in the past about Social Security planning, and some people will say, you're just trying to get people in the door with a Social Security ticket and all that kind of thing. But at the same time, I think of it this way. If they're going to cut back my Social Security in 2033, I want to get the biggest check I possibly can before they cut it back. And that's maybe that's a new reason to wait.
It could be, but if you have those concerns, if you're 60 and you're like, do I turn it on at 62? Or Randy, do I wait to 70? Well, we know 10 years, that's 2035, not 2033.
Yeah.
So do you want to start earlier or later? I'm not going to tell you what to do. Mm-hmm. I'm just going to share the financial data with you, and you're going to determine. You're going to determine it yourself.
Right.
For me, I love to just talk about all this stuff, lay it out, and then we combat it. I had a client that had a tax situation recently, and we looked at it, and they said, can you make the difference up for us in another way? I said, I think so. Let's figure this out. I love doing this. I love working on numbers, Randy. Love it.
Well, there's so many different opinions on this, too, because, one person will say, go ahead, take it at 62, and then invest the money if you don't need it. And I heard somebody else say, take it at 62 because you can pass along your 401k. You can't pass along your Social Security. So, there's so many things to take into consideration here. There's no real way to do it unless you sit down and crunch your numbers, not everybody else's numbers.
It is. And, if you want to take advantage of the Social Security system now and just kind of get on there and draw your Social Security, go ahead and do it. Let's build it in a plan, but let's not figure it as something that we know is the necessary income in the future. Mm-hmm. Let's look at it as the play money, because if we use it as the necessary income, we're going to need to work around it just in case things do change.
It's a huge decision, and it's one that we really need to take seriously, and one that there's a lot of math that goes along with it. Let's do that. That might be one of the things that you're struggling with right now is When should I take Social Security? Should I take it early? I need it. Well, then you do take it early. If you don't need it, sometimes they take it early and invest the money. There's so much to think about. But the only way to really do it is to sit down and do the math on it. Give Mark a call. Give us a look on our website. MoreToRetire.com is the website. More to Retire. Spell it all out. MoreToRetire.com. At the bottom of the page there's a place for you to put in a little information, name and email and phone number and that kind of thing. And then our team will reach out to say, hey, what is it that you're interested in talking about? Where are you in this retirement process? Are you 3 years out, 1 year out, 6 months out, 10 years out? It all really determines on how we're going to attack the problem. And then we get you in for a meeting and really actually crunch numbers for you and come out of it and say, here's what would happen if I retired this year. Here's what would happen if I took my Social Security this year. There's a lot of different options there that you're going to want to know. 984-300-1984 is our number. 984-300-1984, or again, moretoretire.com. And set up a meeting with Mark to go through the pros and the cons, the ups and the downs, the worries that you have about your retirement. And Mark, we have time here. You have an event coming up on May the 31st with an author that you know, and people can actually see the office, come by, meet you, get a book. Tell me about that.
It's fantastic. So great friend of mine, his name's Dennis Lindsay. He wrote a book, The Lens of the Father. The Lens of the Father is on Amazon, so you can order it ahead of time. It's a 100-page read. It's easy to read, and it's fantastic. What I want to do is let you know this is an easy way for you to meet me and meet Dennis Lindsay, my good friend. So it'll be May 31st, Saturday, May 31st from 10 to 12, 10 a.m. to 12 p.m. It'll be floating, and we'll all exchange numbers and have a great time. I'd love to get to meet you. We'll have some refreshments down here as well. So May 31st, 10 to 12, The Lens of the Father, Dennis Lindsay, Mark Osler here at 919 Kildare Farm Road, Suite 1-B, 919 Kildare Farm Road, Suite 1-B.
Love to have the opportunity to meet you, your retirement concerns, have some great conversation, and just kind of kick the tires on Mark and find out if he's a good fit for you and helping you in your retirement years. Here we go. MoreToRetire.com is our website. Again, MoreToRetire.com or 984-300-1984. We thank you so much for listening today, and we hope you have a great weekend, and we'll be here again next week on the Mark Osler Retirement Experience.
Insurance products are offered through the insurance business Mark Osler Retirement Experience. Mark Osler Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Mark Osler Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Mark Osler Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Mark Osler Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.